Hey everyone, and happy Halloween. I'm Denny Troncoso. I'm with Coso Capital Group, and I am a licensed mortgage loan originator here in Florida, doing investment loans in 40 states, and about to be licensed also in Virginia to do buyers that are looking to buy a home, work with regular conventional products there, and then hopefully expand from there into different states. But today I'm actually going to be talking about a program that I'm going to go ahead and share my screen. It's more tailored to real estate agents and how we can work together on doing more business together and also having a little bit less, doing little bit less work in that process. Now, everything requires work, but I think it's being a little bit more strategic for that. So I'm going to share my screen here, and hopefully you can see that there. And so I named this presentation. Hopefully this goes away. Yep. And I named this presentation, it's called, let's move this over. It's called More Business, Less Work with DSCR Loans. All right. And I'm going to explain a few things on how that works here in the next minute. So a little bit about me. I'm a licensed loan originator, former personal financial advisor, back in around 2005 to 2010, work in the health insurance field as well. And then I worked in real estate and finance for about 20 years. So again, the insurance as a real estate broker as well. Now I'm actually inactive at the moment, but I worked in commercial, invested in real estate. I have a strong background in buying commercial property, in particular apartment buildings, and buying homes and rental homes, etc. And then I went to school at UCF, University of Central Florida, go Knights. And I studied real estate and finance there. And then I actually, I'm a scholar, like to study. I like to learn. So in both seminars and university programs. And then I went to USF and actually studied entrepreneurship and applied technologies there. So go Bulls as well. I mean, hard to say that in the same conversation because they're technically rivals, but I don't pay attention to any of that. Now, a real estate investor, like I mentioned, since 2010. Invested in tons of stuff, fix and flip properties, rental properties, subject to, did properties with settlement, have worked with syndicating properties, working with private investors to buy apartment buildings together, commercial loans. So just have a lot of experience in that sector. And then I'm, on some of the things that I like to do for fun. And it's that I'm a coach, probably my son's soccer team, have a 3-year-old, and his name's Lorenzo. And my coach's soccer team doesn't really like soccer now, so we moved to T-ball. He really loved that. And so enjoy that. And then been a high school and college mentor, both at UCF and also at through a program called Take Stock in Children. So, I like to give back and help out as best I can. I had a high school student. It was really tough to mentor him, but I did my best and I'm looking to get a new one here soon. I'm a Toastmaster. If you're not familiar with Toastmasters, is a public speaking organization. If you ever want to, face that fear of public speaking or improve your public speaking, it's helped me out tremendously. It's something you're never going to be perfect at, but you can continue to grow. And they help you with leadership, they help you with speaking, they help you with organizing meetings. So many different benefits there. I highly recommend it, and it's a global organization. So you go to Toastmasters, I believe .org, and you should be able to find a chapter near you. So there's a plug for Toastmasters there. And then I'm a bookworm. I love to read. So if you're ever in conversation, if you ever want to make conversation with me and chat for a long period of time, tell me about what you're reading about. And I was in particularly self-improvement books, biographies, history. Love reading all that. I probably read over 100 books a year, business stuff. Just something I'm encapsulated with. I try to read as much as I can, and particularly audiobooks, but I do read also physical books as well. And then born in the Dominican Republic. Got here to the US when I was 3, moved to New York City, and then grew up really in Orlando. And then for the last 4 years, I've been based here out of Ocala, Florida. So growing Ocala used to be SlowCala. Now it's actually no more SlowCala because it's really growing quite a bit. And then the last thing I'll mention before we get to the bread and butter is that I'm focused on financial and wealth building education. Started a podcast a few years ago. Desiree and I, my wife, we created a few episodes talking about our wealth building journey. And then now I'm starting this mortgage company, this mortgage business, because I'm really focused on helping people go up the ladder in the wealth building. And the first thing is once you have your finances in order, you're making enough money, you have a budget, is really to buy a home. That's the number one way people build wealth here in the United States is through home ownership. So that's really kind of, I was looking, what can I do? And of course, that's the first step. And then I go to a church and they say, the next step is called where well, not the next step, but they have a program. It's called like growth track, and I call this wealth track. So what do you start as a home budget and savings, right? Then home ownership, and then go to maybe buying an investment property. And then the other thing is what wealth people do is they actually invest with other people, which people have done with us in syndication. So it's definitely something I'm passionate about both in education and giving back that way. And then the other way is to provide that education where people can grow and possibly invest with us in future projects because we're working on development projects now, etc. So enough of about me. Now let's get to the bread and butter. How you may feel, right? You may feel like this. You may feel stressed as a real estate agent. And I say stressed because especially when you're starting out, or even if you've been running your business, I've been calling on people I'm connected with because I just started this business and said, hey, let's see how we can work together. And I really talked to a lot of people, and then it's just a lot of overwork, a lot of, especially when you're starting out, a lot of, you don't know exactly what to do because there's just so many things that needs to do. And I mean, I'll talk in another video about, some tips there, but in particular, I'm trying to say how you can use your particular network of people that you've worked with in the past to grow your business where you're not having to go out and generate new business with marketing, cold calls, spending money on marketing, etc. And I believe that this is a really strong avenue that you could pursue, an opportunity, and that'll also be more of a warm approach and could really generate and increase your business in the years to come. And I'll talk a little bit about that. And that program is through the DSCR loans. So what are we covering today? I'm going to talk about DSCR loans. I'm going to talk about how they work and everything there, some details. I'm not going to go too deep, but I'm going to share the basics so you're enough to know enough to be dangerous. And then I'm going to talk about how to use it to generate more business. So that's like I said, how can you do more business and also in a strategic way? How can you partner with lenders like us, people like me? I'm going to talk about something that I learned from another group. It's called it's called a refer back program where we work together and then once the person's ready, we refer them back to you, and I'll show you about that. I'll talk about interest rates today. Today's October 31st. 2024. So I'll tell you what interest rates are. Happy Halloween again. And then to share some endpoints, just a little bit of inspiration, motivation, something I'm excited about. And we'll end there. All right. So talk about 15 minutes or so. Now, what is a DSCR or cash flow loan? So you may not hear about it in the market like that, but you just hear DSCR. I think about it as a cash flow loan. And DSCR stands for debt service coverage ratio. It's something very common in commercial real estate. So if you understand this in residential, then if you ever want to do commercial or buy someone on commercial, this is a common thing with community banks, credit unions, and other institutional lenders that whenever they're financing someone to buy a property or refinance them, they're looking at what is the debt service coverage ratio of the property. They also call it the debt coverage ratio of the property. It means the same thing. Now, how is it calculated? Well, it's in residential in particular, it's based on you take the PD payment, which is the principal, interest, taxes, and insurance, and the HOA, and then you take that cost, and then you see what the rent is of the property, and you divide it. So you take the rent, and now I have it here on the screen. If your payment is $1,000, right, with principal, interest, tax, and insurance, and I know houses are pretty pricey these days, but work with me here. I wanted to keep it simple on the calculation. And you receive rent of $1,200. So the payment on everything, including the HOA, is $1,000, but your rent is $1,200. Then your rent, your net income, right? Your of the property technically, and then you divide the $1,000 and you get a 1.20 debt service coverage ratio. Technically, it's really not the net income, it's just the rent because you would deduct everything out of that. In commercial real estate, you actually take out all the expenses, then you end up with the net income, and then it's NOI divided by debt service. So the debt it would be this is how they're kind of doing it. So simple way to look at it, the rent divided by the PITI payment, including the HOA. So the PITI stands for principal, interest, tax, and insurance, right? And if you want, this is going to be on YouTube, so you can rewatch it. That way, if to know the formula, all right? So in this case, you have a 1.20 debt service coverage ratio. And that means that you're making an extra 20% in income every month on top of the mortgage, on top of all your main expenses, principal, interest, tax, insurance, and HOA. This is actually very good because now you have extra cash flow to put in your pocket, and for unforeseen expenses and for when the property is empty. So you have some savings there that you can start accumulating. Now, whenever you're getting a loan or a person's getting a loan, the banks typically want to see at least a 1.00 debt coverage ratio to be able to do the loan so that the rent and the property pays for itself. Now, if it could be financed when it's negative. So even if the payments are less than the rent, you could still do it. But of course, the interest rate would be higher, and then it would just be a case-by-case scenario. So we could talk about that as well. Now, some main points about debt service coverage ratios, right? I wanted to kind of hit you with the main things about it. Closing time, it's about 30 days. I just closed a loan with a debt service coverage ratio loan, so DSCR loan. And we closed in about 22 days. I believe we could have even closed in 18 days. The borrower had all his finances in order. He got me things quickly. We were able to move very fast. They already had the property. It worked out well. Now, the interest rate on this particular loan, interest rates had gone up. So conventional was around 6.75. The DSCR was about 7.75, right? So think about it at about a point higher than conventional, right? And this is depending on the lender. I work with multiple lenders, so we would shop it with all these lenders to find out what's the best opportunity depending on the borrower. Now this is with a 3-year prepayment penalty, all right? So now comparing to conventional, which has none, now you would have a 3-year penalty, and that is to get that lower rate, all right? So that it does have some additional costs because it's not looking at the borrower's income, it's looking at the property income. They are looking at the borrower for the down payment, and they're looking at the borrower for the credit score. All right, now, so what is it's a typo here, but it's supposed to be what is the amount of the down payment? The amount of the down payment. Let's see, let me fix that. The down payment, all right? It's 15 to 30%, right? It depends on the lender, depends on the debt service coverage ratio. So if the debt service coverage ratio is higher, then you may be able to put less money down. All right, I would really think and focus on 25 to 20% down, right? So that's really the target. A safe number would be more 25%, and it's going to depend also on the credit score of the borrower. So it's a lot of factors in there: credit score, the down payment, and making sure that they have some type of experience. All right. You can shop with the company. So we shop it for you. We look around different companies to see which one, because there's actually a lot of lenders are starting to do this, even some large lenders. And then you can buy real estate with someone else's capital. It says there's equipment, but it's actually, you can buy real estate with someone else's capital. So how does that work? Well, you guys will create an LLC, and that LLC would have an operating agreement, so you could use that company to buy real estate with that. Now, it is for investments only. It is for investments only. You can't buy a primary home with a debt service coverage ratio. That's not anything that right now that program is for, all right? And same thing with commercial. It's for investment properties. Unless, it's an SBA, maybe it's for, business that you're going to operate, et cetera. So that's something different. And then the last one is you have to have experience. And in particular, the experience, they're looking for someone that owns real estate, not necessarily that owns rental property. As long as you own a primary residence or have owned one, that will work because they just don't want people buying primary residences with this loan program. All right. So a few points, closing timeline, 30 days or so or less, depending on the borrowers, how they have their finances organized. Think about a point above in the interest rate. And then think about 25% down, all right, to be safe. We'll shop it with different companies. And then you can use other people's capital. So you can partner with Uncle Joe and they can invest with you and you can buy a property together, right? Now that's, make sure like you work it out right way with securities laws and everything. If you guys are buying together, you guys are partners in this case. So that would, alleviate that. It's for investments only and you require experience. All right. Now, how can you use it to generate more business? Well, if you have a network of people that you've been a real estate agent maybe for 3 to 5 years, 10 years, even longer, you have people that have done closings with you, right? They bought a house and they're happy. They love you. Most of the time, you're able to build great relationship because you're a great real estate agent. You followed up, you did what you said you're going to do, right? You have these strong relationships. The thing in real estate that repeat business is not very strong, right? Because people don't really move until every 6 years or so, right? So you're looking for these particular customers maybe to refer you people if you stay in front of them, right? And I think there were statistics that really customers don't even sometimes they don't remember their real estate agent. So this is a good opportunity to kind of reach out to your clients again and say, hey, John, hey, Mary, I know we closed a house 3 years ago, 5 years ago, 10 years ago. Now, have you ever thought of buying an investment property for your retirement? I have a program I just learned about, and it actually is a pretty flexible investment loan that it doesn't look at your finances. It doesn't look at your income. It looks at the property, how it's producing, and allows people to buy investment property. And then just see what gauge them. People have been watching the HGTV shows. They've been seeing what people are doing with investments, with cash flow, and some of them have interest in that. There may have some apprehension because there are pitfalls if it's not done right, if the person is not financially educated. But then that's where I come in unless you already know how that part works. And I could, advise you or work with you and your client together to educate them on buying a good investment property, right? And I don't mind being, the supporting actor in this movie, right? I don't mind highlighting you and you being the expert there. And I just said, being your investment advisor, right? And the advisor of your clients. So that's a great way, instead of having to knock on doors, make cold calls, do all these things to generate additional business, where it's like, hey, you contacted past clients, Robert and Maria, or Jose and Jane, and say, look, hey, remember, I'm just checking in. I know we bought a property a couple years ago. How's it going? It's going great. Hey, look, guys, have you ever thought about buying an investment property? And kind of see where the conversation goes from there. Of course, it's a game of odds. So maybe 5 people you talk to, only 4 or only 1 is interested. But hey, that's another piece of business that maybe this year, if you have enough clients, maybe you added 5 or 10 closings. I mean, 5 or 10 closings could be, a great amount of income for you, depending on what you've done. Clients, this helps clients that are investors too, that maybe have unreported finances. So let's say some people have business owners, they don't report all their income for whatever reason, tax situation, etc. That helps them out. So you can maybe also be strategic and talk to those customers. Maybe they wanted to buy something, but they were hesitant because of their income. They couldn't. And then also, I'm a big, I harp on real estate agents. You understand real estate investing. You understand real estate. Why don't you, think about adding to your portfolio every 5 years, maybe add an investment property, or even every 10, where this will supplement your income in the future, right? So this is just another way to do well and have a, stable future. So good points there. All right. So now kind of shifting a little gears here and how your lender can help you. And I've shared a little bit about that already, but I'm going to get into it a little bit deeper with you. All right. So interesting statistics. One agent receives 100 leads, right? And talking about a listing agent in particular here, but only 5% or five people end up closing, right? So they end up buying a house or doing a listing, et cetera, right? And then so the and half of them, 50% actually don't get follow-up. This is the national average on what happens with a lead that comes into a real estate agent. Now, some of you, I know you're kings at follow-up. Some of you may have teams, and some of you, the percentage may be higher than that. But this is the national average, right? Now, and I know why it happens is because you're busy, right? You got so much going on that sometimes people fall through the cracks, and then really there's also lack of follow-up. Now, what if you can how can what if you can fix that? What if you can, and let me what if you can you work with a lender like myself and we can team up together to conduct the follow-up. Now, I don't want to make any promises, right? But if me and my team help you with follow-up and add 5 closings or 10 closings, would you work with me? It's not costing you any money. It's not costing you any time and effort. What if we could double your closings from 5 to 10%? I don't want to make any crazy promises, but you were closing, let's say last year you closed 10 deals. What if we can take that to 20 deals? Where on a $5,000 on average per deal, or let's say, I mean, here we're in Ocala, average home's 300 grand, commission is about 3%, $9,000. I don't know what your split is, but let's just say $9,000, easy math, 10 deals. That's an additional $90,000 per year, right? $90,000. You want to say maybe even cut it in half. Hey, what if it was 50,000? $50,000, it would be a great way to just add to your income, do whatever you want, donate, help your kids, pay off debt, whatever. And again, it's not doing a lot of extra work. It's calling past clients, things that you probably should have been doing in the first place. But this is just a conversation starter. All right. So this is, I don't want to harp on that again, but just think about the possibilities and working together on this. And how it works is I know your customer talks to you, you talk to them, you introduce them to us. And then we do a consultation, free consultation with them, see where they're at. And we continuously follow up with them and try to go through on a monthly, every 3 months, we're contacting customers, right? So we have a list of customers and we're calling people. Sometimes weekly, depending on how warm they are. Sometimes we put them on a monthly drip. Sometimes it's every couple of months or 3 months, but every 90 days, we're going through and following up with people and seeing. Some people sprout later, right? Some people are not ready to buy now because they're organizing their finances. Some people are dealing with other things. But we keep contacting them until they say, hey, don't contact me anymore, in a friendly way, and always thinking about you once they're ready to refer back to you. Now, what if there's an additional bonus, right? Because bonuses, everybody loves bonuses. And as an investment advisor, as an experienced real estate investor, what if I can use my skills, right, and add value to you and your business by educating you and your clients, right? So they're looking to buy an investment property, but they don't really know how to make sure that it's a good cash flow property. Well, I know how to do that. I know how to analyze a property and know what expenses should be added in there, what percentage should go for repairs, what percentage should go for management, what percentage should go, for capital improvements. Having all those items in there to make sure that if they're looking at for cash flow, they're able to allocate those things correctly. The other thing is management. Some people say, "Oh no, I'll manage it myself." Well, do you really have the time? So I can educate them on that, and I have videos and information on that where they can learn how to do that. Now, and then also should how if they're going to hire a property manager, which is what I do. Really, I managed in the past, but now I hired third-party management. And how do you hire them? What are the things you're looking for? All those things to help them prepare to make sure they're making the right decision. Tips on working with contractors. How can they find the right contractors? How to vet them? What should they be doing? All those things. Those are just tips, and more things that I've just learned through going through the challenges of being an investor, learning and growing from there. In the trenches is the word I was looking for. All right. So just tons of things there as a bonus. Now, shifting gears. As I mentioned at the beginning, I was going to talk just a little bit about interest rates and closing this up kind of in the home stretch here. And the bond market and has why are interest rates going up, right? Why are interest rates going up? So the Fed cut interest rates by a half a point not too long ago. I think it was early this month or end of September. But interest rates have actually gone up since that happened. So what's really going on, right? The answer is nobody knows, right? Nobody knows exactly. But there's just a lot of little factors that could be contributing to it. And I'll just share a little bit about them and then I'll share really what I think is happening. And I'll take that with a grain of salt, but it just gives you a little bit of bullets so you when you're talking to buyers, because people are interested in interest rates. Well, the first one is the bond market and treasury yields. So interest rates are based on the 10-year treasury and how it moves. The 10-year treasury moves up and down. It was like in the threes, now it's in the fours. So then they kind of there's a premium on top of that, and that's where the 30-year mortgage rate is based on. All right. And now it's been actually going up. That's in the bond market. It's all connected with that on how that works. The second one is inflation concerns. People think maybe inflation is not under control and they're investing. So going back to the 10-year treasury, they invest. They take they're fearful of the 10-year treasury. So when they invest in the 10-year treasury, the demand for the 10-year treasury, when I'm talking about people, I'm talking about institutions, companies with billions of dollars, sovereign wealth funds, national. So Japan, China, all these countries, they also buy the 10-year treasury because it's one of the safest investments in the world for them long term. So they buy that, and then the demand goes up for the 10-year, and that pushes rates even higher, right? So that's with the 10-year treasury. Inflation concerns, people don't fear of inflation, they invest in the 10-year treasury. So there's a fear about that. And inflation concerns could be concerns that inflation is maybe going up higher, right? So not that they are, but just fear that organizations feel. And then we have a big deficit, so that could be related to that's why inflation will continue to go up higher, because we're not, as a country, we're not really paying our bills. We're running a lot of debt. And that's just a reality. And this has been Democrats and Republicans. So both sides have been doing that. Risk premiums. So we have risk premiums where there's I talked about the 10-year treasury and the risk for lending on a 30-year loan, and really those are mortgage-backed securities that after the 10-year treasury, I believe it's mortgage-backed securities is the second largest market on bonds. And if there's not a lot of demand for those things, then rates need to go up to increase the interest that people get on a return on their money, right? So if you're going to buy, if you're trying to, let's say, get a rate of return on an investment, and maybe it's only generating 4%, and there's not a lot of interest, I may try to raise it to 5% to see if more people come in, and maybe 5% is the number, and that's why it's staying around there. But it's actually even been going up a little bit more. It's been kind of a little bit of a roller coaster. So I know, just trying to give you a breakdown of that, right? What it could be. Then the other thing is Fed signals on the future rate policies. And I actually think it's more related to this, right? More related to these 4 and 5. The Fed says we lowered it by half a point. We're going to be watching meeting by meeting. They didn't say they're going to raise rates. They're saying they're going to start cutting rates to get to a neutral rate with a goal of around 5% for long-term rates. Now, and they don't control the short-term rate really, but in the end, it's going to bring it down to that. They only control short-term. They don't control long-term. Now, and this is based on if their expectations of investors say, I don't think that rates are going to go down that fast, then people don't, it doesn't, everything's based on the future, right? Future expectations. If they don't think in the future rates are going to go down that fast, then it's not going to push rates down that fast, right? Because there's just not that expectation. They thought maybe they've been thinking that rates are going to go down, like they're going to do 4 cuts this year or 5 cuts or whatever, but they've been wrong. Investors have been wrong. So now they're like, man, we didn't get the cuts we wanted. Now it didn't push rates down as much as they wanted, right? Kind of in a simple way, investors, as demand grows for these investments, it pushes down rates. The demand is not there, so rates have not come down. And the last one is because the Fed has 2 mandates, and the mandates are full employment and stable prices, right? So those are the 2 mandates. They were focused for the last 3 years on stable prices. Inflation was going up, so they need to stabilize prices, right? Prices can't go up. They're not gonna may not go down right away, but they're gonna stay at least stable, right? But now the unemployment rate has gone up. So full employment is being affected. Full employment is like 3 to 4%. It's like at 4.2 right now, 4.3. So now they're like, okay, now we need to lower rates. Before we were increasing rates to which affects employment, right? Employment. Now they're actually lowering rates to find everything and bring it into balance, right? But that also means that they thought if there was a recession coming, that would drop rates right away, because now they need to do it fast, because you can't see the drop the a big recession, right? So a lot of investors expected that. Maybe there was a fear of that, or recession. And there's no recession near, right? Because it's not happening. So a lot of jobs have still been created. So there's not an expectations that the Fed is going to speed up with rates. That's the bottom line in a short way. So no expectation that Fed's going to lower rate fast, and no expectations of a recession causing that. So that's the economic analysis there. All right, so now let's talk about rates for this borrower. I'm going to talk about rates today, and this is just a borrower scenario. 770 credit, 30% DTI, $400,000 purchase, $320,000 loan amount, 80% loan to value, and a borrower paid origination fee to get the par rate, to get the lowest rate in the market. You can go as a borrower, if you're watching your borrower, or to educate your borrowers, they can choose a lender paid origination fee, where the lender pays my origination fee, or they can choose a par rate where it's just charged at the closing, right? And they get the lowest rate. So this is their choice. It's really the same thing, but it's their choice. All right, rates today. It's for the DSCR loan, I'd say around 7.75%. On FHA, it's around 6%. And on conventional, it's around 6.75%. All right, so finishing up, and I kind of sped up here at the end because I wanted to make sure it's not too long. The Razor, this is a book I read. I have it on my nightstand. I try to read it every day. It's called The 177 Mental Toughness Habits of the World Class. Long title, but great book. And I like it because it's just a 1 to 2 page read per day. And it has just some great tips from the author is Steve Seibelt. I've had it for like 10 years, and I've just reread it. Every time I finish it, I just keep going through it. So it has 177 tips. And this is one of them I put out for you. It says the razor's edge separates the good from the great, or the middle class from the world class. Of course, it's a razor's edge in many different areas, a series of points that make all the difference. The question is not whether it is possible, but whether you have the will, right? So willpower is what it's based on. It's not on education. It's not on knowledge. It's about doing and putting in the effort and fighting through persistence. All right, so let's work together. This is my information, Coastal Capital Group, and our website, coastalcapitalgroup.com, NMLS, my contact number. Again, I told you we can do investment loans in 40 states, and for in particular DSCR loans. And then we're working with home buyers, like first-time home buyers in Florida right now, and then getting ready to be Virginia, and then going to be spreading from there. If you're looking to follow us on social media, follow us on all, we're on pretty much all the social channels in English and in Spanish. And Spanish is called Coastal Capital Latino, just so you know. But then on Coastal Capital on all the social channels, and particularly this one right here is kind of our primary bread and butter with the videos. So with that, we'll end the meeting, but happy Halloween, and I hope you got a lot out of that. Look forward to working with you. All right. Take care. Bye-bye.